The math has finally broken. For months we have watched. We have tracked every delivery notice. We have counted every ounce leaving the vaults. We have warned that the paper market was writing checks the physical market could not cash. And for months the skeptics laughed. Now, they said the system always finds a way. They said the contracts would roll. They said the bullion banks have infinite tricks up their sleeves. But mathematics doesn't negotiate. Physics doesn't care about financial engineering. And today, the numbers have spoken. Welcome to the Market Cipher. I'm here to decode what the mainstream financial media refuses to explain. This morning, the CME Group released the latest delivery notice data for the active silver contract. And what I'm about to show you is not speculation. It's not conspiracy. It's the official data from the exchange itself, and it reveals a problem so fundamental that the entire pricing mechanism of silver is about to undergo a violent recalibration. 52.63 million ounces. That is the total physical silver currently demanded for delivery against COMEX futures contracts. 52.63 million ounces of metal that contract holders are saying, I don't want your cash settlement, I don't want your rollover offer, I want my silver. Deliver it. Now, let me show you why that number should terrify anyone short this market. Pull up the COMEX warehouse inventory report. It's public data. Anyone can verify what I'm about to tell you. The total registered inventory, the silver that is actually available for delivery against these contracts, currently stands at approximately 86 million ounces. 86 million available, 52 million demanded. At first glance, a careless observer might say, well, 86 is bigger than 52. There's enough metal. What's the problem? The problem is that you're looking at a snapshot, not a movie. You're looking at today's number as if tomorrow doesn't exist. You're ignoring the trend, the velocity, and the mathematics of what happens when this pattern continues for another 30 days. Let me break this down so clearly that even a Wall Street analyst could understand it. The COMEX operates on a two-tier inventory system, and if you don't understand this, you will never understand how the silver market actually functions. Tier 1 is called eligible inventory. This is silver sitting in COMEX-approved vaults, but it belongs to private parties. It's their property. They're just storing it there. The exchange cannot touch it. It cannot be delivered against a futures contract, unless the owner explicitly converts it to the second category. Tier 2 is called registered inventory. This is the metal that has been warranted and made available for delivery. When someone holds a futures contract to expiration and demands their silver, it comes from the registered pile. Here's the critical insight that most analysts miss. Eligible inventory is not a reserve. It is not a backstop. It is private property that may never enter the deliverable supply. Think of it this way. Imagine a parking garage attached to a car dealership. The eligible inventory is like the customer cars parked there for service. The registered inventory is the actual lot inventory available for sale. Just because there are 500 cars in the garage doesn't mean the dealership can sell them. They don't own them. When the mainstream financial media reports total COMEX inventory, they combine these categories to make the supply situation look healthier than it is. They say, oh, there's 270 million ounces total. What they don't tell you is that 184 million of those ounces are eligible, untouchable, irrelevant to the delivery equation. The only number that matters for contract settlement is registered, and registered is 86 million against 52.63 million demanded right now. Now let's do the math that the banks are praying you never calculate. If 52.63 million ounces are standing for delivery this month, that represents 61.2% of the total registered inventory. In a single delivery cycle, the market is demanding more than 60% of all available supply. But here's where it gets worse. This isn't a one-time event. This is a trend. Go back and look at the delivery data from 3 months ago, 6 months ago, 1 year ago. What you will find is a consistent pattern. Standing delivery demands are increasing and registered inventory is decreasing. 12 months ago, registered inventory was approximately 38 million ounces higher than it is today. Where did that silver go? It went out the door. It was delivered to the entities who refused cash settlement and demanded their metal. Let me frame this trajectory in terms anyone can understand. If the current pace continues, if we see 50 million plus ounces demanded each major delivery month, while registered inventory continues to decline at the current rate, we hit zero within 4 to 5 months. Not zero as in slightly tight. Zero as in the delivery mechanism of the world's primary silver pricing exchange physically cannot function. And before the skeptics say, oh, they'll just convert eligible to registered, let me address that directly. Conversion requires consent. Those eligible ounces belong to someone. They might belong to industrial users who need that silver for solar panels or electronics, and they might belong to ETFs whose shareholders expect the metal to be there. They might belong to foreign entities who have no intention of selling at current prices. You cannot force conversion. You can only incentivize it, and the only incentive that works is price. If the registered category runs dry while demand remains elevated, the only solution is for price to rise high enough that eligible holders voluntarily choose to sell. And that means price discovery. Real price discovery. Not the managed, suppressed, derivative-driven price discovery we've had for decades. The free market is about to return to silver, and the free market is going to be violent. Now, some of you might be wondering, why hasn't this already blown up? If the math is so obviously broken, why is silver still trading at current levels instead of $75 or $100? The answer reveals the architecture of modern commodity suppression. The paper market and the physical market have been operating as two separate universes. In the paper universe, banks can create unlimited contracts. They can sell promises of silver that doesn't exist. They can naked short the market into oblivion because settlement is usually in cash. Most speculators don't want the metal. They want to bet on the price, collect their profits, and move on. This system works as long as the physical universe remains compliant. As long as miners keep producing, as long as industrial users keep accepting delays, as long as investors keep accepting paper proxies instead of demanding real metal. But the system has a fatal flaw. Anyone can demand physical delivery, and enough people demanding delivery at the same time breaks the entire mechanism. What we are witnessing with this 52.63 million ounce demand is not normal market activity. Normal market activity sees 70 to 80% of contracts roll to the next month. Cash settlement, paper games continuing forever. This delivery demand represents a crisis of confidence. The entities behind these contracts, whether industrial users, sovereign funds, or large private investors, are looking at the world and deciding that paper promises are no longer acceptable. They see the supply deficits. They see the solar panel boom. They see the military applications. They see the monetary instability. And they are saying, I don't trust you to deliver later. I want my metal now. This is a run on the bank, except the bank in question is the entire paper silver market. And the timing could not be worse for the banking system. We are not operating in a vacuum. The silver situation exists within a broader context of commodity stress, dollar instability, and geopolitical fracturing. China has been systematically draining physical precious metals from Western vaults. The Shanghai premium, the price difference between Chinese silver and Western silver, has been running elevated for months. This tells you that Eastern buyers are willing to pay more than Western spot to secure physical metal. Why would anyone pay a premium if supply was abundant? They wouldn't. They pay premiums when supply is scarce and they're desperate to secure it. Simultaneously, we're seeing historic drawdowns in London vaults. The LBMA, which is supposed to be the deep, liquid heart of the global precious metals market, is experiencing inventory levels that would have been unthinkable 5 years ago. The silver is leaving. It's moving from west to east. It's moving from vaults to factories. It's moving from paper promises to physical possession. And as this movement accelerates, the COMEX registered inventory becomes increasingly critical. It's the last major pool of warranted, deliverable silver in the Western financial system. 86 million ounces sounds like a lot until you realize global industrial demand is approximately 700 million ounces per year. The entire registered COMEX inventory represents about 45 days of industrial consumption. 45 days. That's the buffer between the current system and a delivery crisis. So what happens when registered inventory gets critically low? Let me walk you through the doom loop that the bullion banks are desperately trying to avoid. Stage 1. Registered inventory drops below 60 million ounces. At this point, a single large delivery month could theoretically clear out the entire vault. Market participants begin to panic. The smart money accelerates their delivery demands. Stage 2. The squeeze becomes self-reinforcing. As inventory drops, more participants decide they need to take delivery now rather than risk waiting. This increases delivery demand, which drains inventory faster, which creates more panic. Stage 3. The COMEX faces a binary choice. They can either allow a full-blown delivery default, admitting that the contracts cannot be honored in metal, or they can implement emergency measures, position limits, forced cash settlement, trading halts. Both options are catastrophic for confidence. A default proves the market is a fraud. Emergency measures prove the market requires manipulation to function. Stage 4. Price decouples. The paper price becomes meaningless. Physical silver trades at whatever price clears the market in the real world. We saw a preview of this in 2020 when retail premiums spiked to 30 or 40% over spot. Now, imagine that dynamic, but at the institutional level. This is not fear-mongering. This is the logical mathematical consequence of the situation the data reveals. And here's what I need you to understand. If you have been accumulating physical silver, if you have been enduring the ridicule of friends and family who think precious metals are a boomer investment, if you have been watching the paper price and wondering when the physical reality would finally be recognized, the recognition event is approaching. The 52.63 million ounces standing for delivery are not an anomaly. They are the beginning of a trend. They represent a fundamental shift in how market participants view paper versus physical. They represent the institutional awakening that the retail stackers experienced years ago. You were early, but early is not wrong. Early is positioning before the crowd arrives. The entities demanding these 52 million ounces are not retail investors buying coins on the internet. These are sophisticated players moving serious weight. They have done the same math I just showed you. They see the same inventory reports, and they have concluded that securing physical metal today is more important than saving the modest premium over paper settlement. When the sophisticated money acts, you pay attention, and the sophisticated money is acting. So what comes next? Let me give you the framework I'm watching. First, monitor the registered inventory weekly. This is your canary in the coal mine. If we see a drawdown of 5 to 8 million ounces per week, sustained over the next month, the timeline to crisis compresses dramatically. The CME releases this data publicly. Track it. Second, watch the spread between spot and futures. In a healthy market, futures trade at a slight premium to spot, reflecting storage costs and interest rates. When spot starts trading above futures, a condition called backwardation, it signals that immediate physical metal is more valuable than future promises. Backwardation in silver is historically rare and historically predictive of violent price moves. Third, observe dealer behavior. When major bullion dealers start extending shipping times, limiting purchase quantities, or widening spreads between buy and sell prices, you're seeing the physical market tighten in real time. These dealers have direct relationships with wholesalers and mints. They see the pipeline before it shows up in official data. Fourth, prepare for volatility in both directions. The banks are not going to surrender quietly. They may attempt coordinated paper selling to shake out weak hands. They may issue bearish research reports. They may use their media connections to create fear, uncertainty, and doubt. Do not be shaken by paper price manipulation. The physical reality is the only reality that matters. And the physical reality is 52 million ounces demanded against 86 million available. The financial system operates on confidence. It operates on the belief that promises will be kept, that contracts will be honored, that the metal behind the paper actually exists. The 52.63 million ounce delivery demand is a confidence test. It's the market asking, do you actually have it? And for the first time in modern history, the answer is becoming uncertain. You are not witnessing a normal market fluctuation. You are witnessing the exposure of a fractional reserve paper system that has traded on confidence for decades and is now facing a physical reckoning. The math doesn't work. 52.63 million against 86 million registered, with more delivery months coming, with inventory trending down, with Eastern demand pulling metal off the market permanently. The math doesn't work, and when the math doesn't work, something breaks. Position accordingly. Understand that the physical metal in your possession has no counterparty risk, no delivery uncertainty, no reliance on a system that is showing visible cracks. The cipher is clear. The pattern is revealed. The market is telling you exactly what's coming if you're willing to listen. This is the market cipher. The math is broken. The delivery mechanism is strained. And the physical market is about to remind the paper market who's really in charge. Like and subscribe if you want to keep seeing the data the mainstream ignores. Share this video with anyone who still thinks silver is just another commodity. The reckoning approaches. Make sure you're on the right side of it.